It's been a while since I last talked about options, and since then, there's been quite a number of people who are interested in trying out options, but at the same time, might be feeling a little intimidated by all the numbers that's appearing on the screen. So, in this video, I'll be explaining the whole options thing and break it down for you. What are options? Why are there so many numbers? What do they mean? And at the end of the video, I will also show you what are the ways you can trade options. And yes, I will admit that options may feel a little complicated at first. But if someone as noob as me can understand options, I believe you will do just fine. Also, throughout the video, I'll be using the Moomoo Singapore app to explain this whole options thing. Which, by the way, if you have not signed up already, you can just sign up using my link down below, deposit $2,700 to get your free Apple stock, $20 cashback, and commission-free options trading for 30 days. With that being said, let's jump right in. Okay, in the app, to find the options for a specific stock, all you need to do is tap on a stock. In this case, it is Apple. Then tap on options, and you will come to the options page, or better known as option chain. There are two types of options here, a call option and a put option. All these numbers here on the left side are call options, and all these numbers here on the right side are put options. Okay, I'll just focus on the call options for now, because once you understand what's a call option, you will also understand what's a put option. Basically, a call option gives the option buyer the right but not the obligation to buy a stock. Yes, I know it sounds like an alien language, so let me try to explain it using simple English. Let's say you want to buy a house, maybe this super expensive $1 million HDB in Tampines. Think of this house as your stock. But in most cases, you don't buy the house immediately on the spot, right? Because we need to first sign all the lawyer letters and get the loans approved. Only after that is done, then we'll finally get to own the house. But in the meantime, if you want to reserve our house, you first need to pay a deposit to the sellers, typically around $5,000. This 5K deposit is the exact same thing as an option. That's because 1. You're using the 5K deposit to reserve the $1 million house. You now have the right to buy the house, but not the obligation. So if you suddenly change your mind, then you don't have to buy the house. 2. This deposit won't last forever. It will typically expire after 21 days. Same for options. Different options will have different expiry dates. It will typically expire on Fridays. And you can find options that expire as early as this week all the way to a few years later. So that's a simple example of how options work. The house is the stock and the deposit is the call option. Let's look at the call option. In the app, if I tap on the call button here, it will only show all the call options. Okay, this call option is at the $140 strike price. This is the one thing that gets many people confused, where they think the strike price is the price of the option. But let's think back to the buying a house example. You are reserving a $1 million house with a 5K deposit. Same thing here. You are reserving a $140 stock with a call option that costs $5.65. So strike price is different from options price, yeah? Okay, here's another important thing to take note of. We call each option an option contract, and each option contract represents 100 shares of the underlying stock. That means whenever you try to buy or sell options, you need to buy it in multiples of 100. So in this case, if you are buying this call option, you will be spending $5.65 multiplied by 100 stocks, or $565. In return, that gives you the right to buy 100 stocks at $140. Right now, Apple is trading at around $143.21. That means all the call options that are lower than the current stock price are in the money. So if you were to exercise in the money call options, you will be owning stocks at below the market price, which you could then sell them for an instant profit. For example, if you own a call option at $138 strike price, you could exercise the call option to buy the stock at $138. Then sell the stock at the current market price for around $5.21 profit. Next, the option that's trading at $143.21 is called at the money option, though there's no $143.21 options here. Finally, all the options that's trading higher than the stock price are out of the money. And if you were to exercise a call option that's out of the money, you will end up buying the stock at higher than market price. For example, you are buying at $147 instead of the current $143. Because of that, you can start to see why the deeper in the money the option is, the higher the option price, because you can exercise deep in the money options for a bigger profit. On the other hand, the more out of the money the option is, the lower the stock price, all the way to just $0.01. That's because this option is practically worthless. It's even cheaper than your $3 chicken rice. So that's in the money, at the money, and out of the money. Next, let's talk about what affects option price, or also known as option premium. Let's use this call option as an example. This call option is worth $5.05. If you were to exercise this option, you would then be able to sell the stock at $143.21. That will give you $2.21 profit per share. So out of a $5.05 premium, this $2.21 profit is also known as intrinsic value, aka the value that you will get if you exercise the option. But what about the remaining amount? In this case, it is $2.84. We call that the extrinsic value. If you have been to Wall Street bets, you might have seen people earning tons of money trading options. And that is possible because of extrinsic value. Here's why. Extrinsic value is made up of two parts. Let's talk about the first part first. Time value, aka how much time there's left before the option expires. Here, we can see that this $140 call option that's expiring this week is worth $6.75. And if we change to a further expiry date, the call option at the same strike price is now worth slightly more. And if we go all the way to 3 years later, the option at the same strike is now worth almost 5 times more. That's because the more time that you have, the higher chance of the option going deeper in the money. Hence, options that have longer expiry dates have a higher time value. Next, the extrinsic value is also affected by the implied volatility, or IV. IV represents the expected volatility of a stock. Basically, if people expect the stock to move a lot more, the IV will go up. That's because the more the stock moves, the higher chance of it going deeper in the money. And as a result, stocks that are more volatile have higher IV. So, for example, Bank of America, where the stock is only moving like $1 to $2 a day, its options will have lower implied volatility. Compared to Tesla, where it's moving $10 to $20 a day, the options IV would be a lot higher. IV can also be affected by uncertainties. An example of that is right before the company is about to announce their earnings. As people are unsure whether the results would be good or not, the uncertainty will cause IV to go up. And once the results are announced, there's no more uncertainty and IV will go back down. So, in summary, options premium consists of both intrinsic and extrinsic value. Intrinsic value is the value that you will get if you exercise the option. Extrinsic value is affected by factors such as how much time there's left before the option expires and whether there's expectations that the stock will be more volatile or not. Fun fact, you can actually find all these numbers in the Moomoo app. So if I go to column settings and choose to show the price, intrinsic value and extrinsic value, which they put as time value, you will see that the sum of intrinsic value and extrinsic value is the option price. Also, you will see that options that are out of the money, aka options that have a higher strike price than the current stock price, don't have intrinsic value. That's because if you try to exercise out of the money options, you will instantly lose money. And that is also the reason why at expiration day, when options lose all their extrinsic value, out of the money options are worth $0. Okay, if you have made it this far, you are breathtaking. there's only a few more sections left to go. So just hang in a bit more, yeah? In this next session, I will talk about something called the Greeks. What? More numbers? Yes, more numbers. But I promise you that I will try to explain it as simple as I can, yeah? So, what are option Greeks? Greeks are just numbers that define how option prices move. There are 5 Greeks that you need to know. The first Greek is called delta. In simple terms, delta is how much the option price moves whenever the underlying stock moves by $1. Basically, it just measures how sensitive is the option price in relation to the stock price. Let's look at an example. For this $140 call option, it has a delta of 0.64. What this means is that if the stock goes up by $1, the option price will go up by 64 cents. Likewise, if the stock goes down by $1, the option price will also go down by 0.64. Here, you will notice something interesting. Options that are deeper in the money will have higher delta, while options that are further out of the money have lower delta. Why is that the case? Recall the intrinsic and extrinsic value that we talked about earlier. You will recall that the options that are deeper in the money have higher intrinsic value. That's because if you exercise deep in the money options, you will be able to sell the stock for a higher profit, right? And so, when you have higher intrinsic value, the option price will also move a lot more when the underlying stock moves. That's why it has a higher delta. But what about out of the money options where there's no intrinsic value? In that case, the answer is also very simple. The further out of the money it goes, the lower its extrinsic value because it has a lower chance of going in the money. That's why delta is lower for further out of the money options. So that's delta. It measures how sensitive the option price is in relation to the stock price. The next Greek is gamma. Gamma describes how much the delta changes when the underlying stock moves by $1. For example, for the $140 call option, we can see that delta is 0.64 and gamma is 0.038. If the underlying stock were to go up by $1, the delta will increase by 0.038 to become 0.68, which means that when the stock goes up by $1, this option price will now go up by 0.68. So that's how gamma works. Here, you can see that the deeper in the money the option is, the lower the gamma. Likewise, the further out of the money the option is, the lower the gamma. Or in other words, the nearer at the money the option is, the higher the gamma. Why is that so? That's because when you are far out of the money, there's a lower chance of going in the money. Because of that, no one cares about your far out of the money option and gamma will be low. But if your out of the money option is right next to at the money, there's a very high chance of going in the money. In that case, there's a lot of interest in the option and hence gamma will be high. The opposite is true. If the option is in the money, no one cares about your option because it has a higher chance of staying in the money. In that case, gamma will be low. So that's gamma. It just measures how sensitive the delta is in relation to the stock price. Personally, I feel that gamma is not that important. The more important number is actually delta. Okay, let's move on to the next Greek, theta. Theta is how much the option price will decay when each day passes. Okay, this is simple to understand. We all know that option price consists of intrinsic value and extrinsic value, right? Theta is saying that how much extrinsic value this option is losing every day. So, for example, for this $140 call option, its theta is negative 0.11. What it's saying is that by tomorrow, the option price will fall by 0.11. Let's visualize this. This is a time decay graph of an option. The x-axis is showing how much time there's left till expiration, and for y-axis is showing the extrinsic value of the option. What you will notice is that the longer time that we have till expiration, the slower the option decays. But when we get to the final 30 days, the option is decaying at a much faster rate. I will use the options profit calculator to show you why this is important. I will use Apple as the underlying. Let's set the expiration date to 1 month later. And I will choose an option that's far out of the money. Apple is at $143, so I will choose $170 option strike price. Here, you will see a profit loss chart for this option. On the first day, you won't have any profit or loss on your option. But on the second day, data starts doing its thing and the option loses some of its value. So to not lose money on this option, the stock price has to go up by $1 for it to break even. This continues every day, where the option is losing more and more value until on the last day, the option loses all its value, and the stock has to go up to at least $171 for it to break even. Let's use another example, but now I will choose an in the money option. What you will see is that because there's very little extrinsic value, there's nothing much to decay. And because of that, the stock has to only go up by $3 by expiration for it to break even. While in the previous example, the stock has to go up by $30 to break even. So that's the effect of theta on the option price. The further out of the money the option is, the faster the decay. The fourth Greek is Vega. Vega is how much the option price will move for every 1% change in implied volatility. For example, for this $140 call option, Vega is 0.11. So if IV goes up by 1%, the option price will go up by 0.11. Similarly, the nearer at the money the option is, the higher the Vega, because there's more uncertainty around the area, whether it will be in the money or out of the money. This Vega is important because if you are buying options, you will want to avoid buying when IV is high, like right before the company released their earnings result. Because what usually happens after that is something called IV crash, where the implied volatility drops back down to normal values, and that causes option to lose its value. So if you are trading options, pay attention to its IV. You want to buy when IV is low and sell when IV is high. The final Greek is Rho. Rho is just how much the option price changes when the risk-free rate, aka the US Treasury interest rate, changes. But you can just skip this part because it has very little effect on option prices. So those are the option Greeks. Here's a quick summary. Delta measures how sensitive the option is to the change in the stock price. Gamma measures how sensitive delta is to the change in stock price. Theta is how much the option is losing value every day. Vega is how sensitive the option is to the change in implied volatility. And finally, we can just ignore Rho. Phew, we are finally done with the Greeks. That was the hardest part. Everything from here on is easy, yeah? So all along, we have been talking about call options, which, as you remember, call option gives you the right but not the obligation to buy the stock. You are now ready to talk about put options. A put option gives you the right but not the obligation to sell the stock. So remember, while call lets you buy the stock, put lets you sell the stock. Here are a few things to take note of. First, for call option, strikes which are lower than the current stock price are in the money, because it's better to buy the stock at a lower price so that we can sell it for more profit, right? For put option, it's the exact opposite. Strikes which are higher than the stock price are in the money, because it's better to sell the stock at the higher price for more money. So let's say Apple is at $142 now. If I exercise a put option at $150 strike price, I'll be able to sell 100 Apple stocks at $150, thereby profiting $800. But if I were to exercise an out of the money put option at $130, I will be selling at a negative $1,200 loss. That's why a put option that's lower than the current stock price is out of the money. Okay, the second thing is that the Greeks are a little different now. Delta for call option is positive, but for put option is negative. The reason is simple. When the stock price goes up by $1, put option goes slightly out of the money and starts losing a bit of value. That's why the delta is negative. Vega for both call and put is positive, which, as you remember, Vega measures how much IV affects the option price. The higher the IV, the higher the option price. Data for both call and put is negative. So for each day passes, both call and put are losing value. Finally, gamma for both call and put is also positive. Basically, it just says that whenever the stock moves by $1, delta changed by the same amount. So the only thing different here is delta and rho, but we will ignore rho. Next, for calls to break even, the stock has to go up, and for puts to break even, the stock has to go down. Okay, here's a chart to make it clearer. This is the profit loss chart for a call option. The x-axis is the stock price, and the y-axis is the option price. So let's say if you buy a call option with a $100 strike price for $2, that means you pay $200 for the option. If the option expires out of the money, you will have a max loss of $200. Then if the option goes in the money, we start to recover some of the losses, and at $102, we will break even because we spent $2 to buy the call with a $100 strike price. So $2 plus $100 is $102. Then the higher the stock goes, the higher our call option profit. So that's the profit loss chart for a call option. For the put option, it's flipped around. If the stock goes up in value, the put option will expire worthless and we will lose everything. But the lower the stock goes, the higher our put option profits. So there you have it. If you have reached this far, you will have a basic understanding of how options work. For everything that I mentioned just now, you can find all of it in the Moomoo Singapore app. You can see stuff like the IV, the 5 Greeks, intrinsic and extrinsic value, break-even price. Also, you will see 3 different option prices: the bid, ask, and the price. If you have traded stocks before, you will know what this means. Basically, the bid price is where everyone is queuing to buy the option. For example, at the 135 strike, you can see that there are 117 orders to buy the option at 450. Ask price is where everyone is queuing to sell the option. In this case, there are 23 orders to sell the option at $4.75. And the price is the last price where someone has just sold this option to a buyer. For this option, there's a 25 cents spread between the bid and ask price. If you join the queue at 450, you might have to wait for a while before your option gets filled. And if you buy it immediately from the sell queue at 475, you might be overpaying for the option. So what's the best solution here? One possible way is that when you are buying an option, you can choose a middle point between the bid and the ask price, or also known as mid price. That way, you don't have to wait too long before your order gets filled, and you don't have to overpay for the option. Besides that, we also have volume, which is how many contracts have been traded today. Turnover is how many options have been traded over its lifetime. And finally, open interest is how many contracts that are currently open right now. So if you check this 140 strike option, it has an open interest of 1,025 contracts. If the stock doesn't go above $140 by the expiration date, all these people are going to lose all the money on this call option. Besides that, you will also notice that the further away from at the money the option is, the lower volume it will have. That's because if an option is too deep in the money, it is almost guaranteed to be in the money. So there's no point trading it. Likewise, if it's too far out of the money, it's almost guaranteed to expire worthless. So there's not many people trading it. People will just trade near at the money because with uncertainty comes reward. Okay, let me just quickly show you how to buy an option in Moomoo Singapore app. In the app, tap on the stock that you want to buy the option for. I will try Apple. Go to options, choose your option's expiry date. If you want to buy a call, you will choose from the call option column. And if you want to buy a put, you will choose from the put option column. Let's try buying a $136 strike call option. Here, you will see how the option moved in the past. If you want to check the IV, you can tap on this IV button. Further down, you will see a price calculator. If you drag the date slider, you will see how much the option decays by on a certain date. To buy the option, tap on Trade. Choose your order type. The two main order types are limit order, where you can specify what price you want to buy the option at, and market order, where you buy at the best possible price. Let's use limit order. You can set a price that you prefer, but if you want, you can also change to the mid price. For quantity, if you are buying one option contract, you enter 1. Remember, each option contract equals 100 stocks. So that's why even though this option costs $2, we are paying $200 to buy this option. Tap buy and you are done. If you want to see your options, you can go to trade and you will see the option that you have bought. Now let's try selling this option so that you can retire at the beach or something. To sell the option, just tap on the option that you have bought. Tap trade, enter the amount, price, then tap sell. So that's how to sell the option. If you want to check the orders, just go to trade, look for order history. Here, you will see that I have bought it for $2.03 and sold it for $2.03. No win, no loss there. So that's how to trade options on the Moomoo Singapore app. Finally, let's talk about how you can trade options. The first method is to do it the Wall Street bet style, where you go and buy into short expiry out of the money option and pray that it will go in the money before it expires. This style is high risk, high reward, where you either make it big or you keep losing until your account goes to zero. Personally, I don't like this method, as the chance of losing money is very high. The second method is to use something called a spread, where you combine two or more options to create different option strategies. A simple spread would be the bull call spread, where you buy a call, then sell another call at a higher strike price. This limits how much you can lose so that you don't lose all your money. But at the same time, it also limits how much you can earn. There are tons of spread strategies to choose from, depending on what you need. This method is good if you have a limited amount of capital to use. But the downside is that your profits are capped. Personally, for me, I don't like to use spreads, because if you ever lose money doing a spread, you will end up with less capital to work with, which is quite bad, especially if you don't have much to begin with. But even if you make money, you don't make a lot because your profits are capped. So for me, I prefer using the third method, which is to sell options. There are two main option selling strategies: covered call and cash covered put. I won't go into it in this video because that's an entirely whole topic on its own. But if you want to know more, you can check out this video here. I have been selling options for a while now, and I found that the success rate of selling options is very high, and I was able to generate quite a decent profit every month by just selling options. But there are two downsides here. One, you need a large capital to sell options. So, for example, if I want to sell a put option on Google, I will need to prepare $9,000 on the sidelines just in case I'm forced to buy 100 Google stocks. Second, if you are anyhow selling options on random meme stocks, and if the stock crashes, which is a common theme nowadays, you'll be forced to buy 100 stocks at a huge loss. Which brings me to my last point. If you don't have enough capital to trade options, just do nothing. Don't trade options, yeah. The biggest danger about options is when people treat it as a get-rich-quick scheme, while totally ignoring all the risks. That's how you lose money. If you don't have money, the first thing you need to do is go earn more money elsewhere. Maybe by changing jobs, getting a promotion, working a second job, starting a YouTube channel. Your goal is to grow your main income first. Then, when you have more money to invest, only then you are in a better position to come back and look into options. So that was a super long tutorial. Thank you so much for staying all the way through. I don't usually make such long tutorials, but I wanted to make this as I felt that it would be useful for you guys. So hopefully you find this useful. Anyway, that's all for today. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.